7 years. That is roughly how long it has taken for the combined Truist Financial, the bank born from the 2019 merger of BB&T and SunTrust, to get to the point where you can look at the earnings and say, yeah, this is starting to work.
Q1 2026 was a meaningful step in that direction. Adjusted EPS of $1.09 beat the $1 consensus by 9%. ROTC at 13.8%, up 150 basis points year over year. A $5 billion buyback target announced for the full year.
But the story isn't clean. NII guidance got cut from 3 to 4% down to 2 to 3%. Net charge-offs ticked up in the commercial construction portfolio. The revenue line missed the consensus estimate. So we have this interesting tension. The EPS beat is real, but some of the underlying drivers are still messy.
Which is exactly why Truist is worth talking about right now. The thesis is not that it's a perfect bank. The thesis is that it's a significantly improved bank trading at a discount to where its earnings power should take it over the next 2 years.
I'm Hudson Thomas, this is Lana Chen, and this is Charged Alpha, the show where we break down earnings, strategy, and what's actually moving the stock. Today it's Truist Financial, ticker TFC, Q1 2026. Let's set the stage.
Truist Financial was formed in December 2019 from the merger of BB&T Corporation and SunTrust Banks. BB&T traces its roots back to 1872 in North Carolina. SunTrust was founded in Atlanta, Georgia. Together they created the 6th largest commercial bank in the United States.
And the numbers are substantial, about $549 billion in total assets, nearly 1,930 banking offices across 17 states and Washington, D.C., roughly 10 million consumer households. The footprint runs from Virginia down through the Carolinas, Georgia, Florida, Tennessee, Alabama, and into Texas.
That Sunbelt geographic concentration is genuinely valuable. These are among the fastest-growing population and business migration markets in the country, and Truist holds leading deposit market share in many of them.
The business runs across 2 main segments. Consumer banking and wealth handles retail deposits, mortgages, credit cards, and small business. Wholesale banking covers commercial lending, capital markets, and investment banking. And the wealth management and investment banking platform has been a surprise to the upside. Fee revenue hit its highest quarterly level since 2021 in Q1.
The deposit base is roughly $415 billion. That's the low-cost funding engine that makes this model work. The challenge over the past several years has been proving the merger was worth the complexity it introduced. The integration work is now largely done. And that changes the story.
It changes what investors can underwrite. For the first time since the merger, you can look at Truist and say the noise is mostly behind it. What's left is the fundamental question of how good this bank actually is.
CEO background: Bill Rogers. William H. Rogers Jr. has been at this institution, or its predecessor SunTrust, for 45 years. He started in 1980. His entire professional career has been inside one franchise.
That kind of institutional depth is rare in American banking. He built his career through corporate banking, retail, private wealth, and mortgage, essentially ran every major business unit before becoming chairman and CEO of SunTrust. When the SunTrust and BB&T merger closed in 2019, he became president and CEO of the combined Truist in September 2021.
And the challenge he inherited was enormous, integrating 2 massive institutions with different cultures, different technology stacks, and different customer bases. His approach has been to cut costs aggressively, sell non-core assets like the TIH insurance subsidiary, and focus capital on the core banking franchise.
The TIH sale was a defining early move. He took capital that was tied up in an insurance business and redirected it toward share buybacks, accelerating the ROTC's recovery by reducing the equity base while earnings improved.
The results are starting to validate the playbook. ROTC of 13.8% in Q1 2026, with a clear target of 14% for the full year and 15% for 2027. 45 years at one institution means he knows where every body is buried and where the earnings power is hiding.
All right, Lana, let's dig into the financials. Q1 2026 results are in. Walk me through it.
Starting at the top, adjusted EPS of $1.09 against the $1 consensus estimate, and that's a 9% beat and a 25% improvement year over year from the 88 cents in Q1 2025. Strong number.
The headline beat is clear. What's underneath it?
Net interest income was $3.599 billion, up about 2.6% from Q1 2025's $3.507 billion. The net interest margin came in at 3.02%, roughly flat year over year. Total reported revenue, NII plus non-interest income, was $5.152 billion, which came in just below the $5.17 billion consensus estimate. A very modest miss, but a miss.
And the fee income piece, that's the bright spot?
That's the bright spot. Investment banking and wealth management revenues hit their highest quarterly level since 2021. Management is guiding for double-digit fee income growth for the full year. That's not just noise. It represents a real diversification of the earnings base away from rate-sensitive NII.
NIM at 3.02%. Where is that going?
That's where the guidance gets complicated. Management revised NII growth guidance for the full year from 3 to 4% down to 2 to 3%, citing the expectation that the Fed holds rates steady in 2026. They still expect full-year average NIM to exceed the 2025 average of 3.03%, but the bar for NIM expansion has narrowed. This is the number the bears are focused on.
Credit quality, the NCO rate?
Net charge-offs were 61 basis points annualized, and the sequential increase was driven by elevated losses in the commercial construction portfolio. That's the number that put a damper on what was otherwise a strong earnings report. The commercial real estate exposure is real, roughly $40+ billion across construction and development, and investors are watching it closely in an uncertain macro environment.
ROT 13.8%.
13.8%, up 150 basis points year over year. Management is targeting 14% for full year 2026 and 15% for 2027. The long-term target is 16 to 18%. Each step of that ROT's ladder, if delivered, justifies a higher multiple on tangible book.
Balance sheet and capital, where does that stand?
Total assets $549 billion. CET1 ratio at 10.8%, well above the regulatory floor and above the level that gives management comfort to run the buyback aggressively. Tangible common equity per share implies the stock is trading at about 1.54 times tangible book at the current price. And a dividend yield of 4.1% with an annual dividend of $2.08 provides meaningful income support. Overall, Truist Financial's financial health is watchful. ROTC is improving and integration headwinds are fading, but the NII guidance cut, above peer NCO rate, and below peer NIM keep this in the show me category for now.
What does Wall Street make of Truist right now? Because the consensus picture is more mixed than what we usually see on a 9% EPS beat.
The Analyst Consensus is moderate buy, 14 buy ratings, 15 holds, and 4 sells out of 33 analysts. The average price target is $56, which is about 10.7% above the current price. That's reasonable upside, but not the kind of enthusiasm you'd see if the market believed all of the bull case unconditionally.
And the individual analyst actions post-earnings.
Morgan Stanley maintained overweight and raised their price target from $57 to $63, one of the more bullish calls, citing the OT's trajectory and capital return as the dominant thesis. JP Morgan held neutral and moved from $51.50 to $54, acknowledging the EPS beat but pointing to the NII guidance reduction as a concern. Barclays reiterated overweight, raising from 55 to 60. Goldman Sachs stayed neutral, moving from 50 to 54, and Wells Fargo held equal weight at 52, consistently below consensus on TFC.
4 sell ratings out of 33 analysts is notable. That's not nothing.
It reflects the genuine divide in the street. The bulls are focused on the merger completion, the ROTC trajectory, and the buyback capacity. The bears are skeptical that NIM can expand meaningfully from 3%, concerned about commercial real estate, and questioning whether the 15% ROTC target by 2027 is realistic without a rate cut tailwind.
And the most recent earnings print itself.
Q1 2026, EPS beat at 9% above consensus, revenue slight miss. The previous 3 quarters, Q2, Q3, and Q4 of 2025, were all EPS beats with revenue beats as well. This is the first revenue miss in 4 quarters, and it came directly from the NII guidance reduction. That's what injected skepticism into what was otherwise a solid report.
Let's lay out both sides. You take the bull side first.
The bull case starts with the merger completion story. Truist has been dealing with integration headwinds since 2019. Elevated costs, systems complexity, cultural friction, that's largely resolved. What's left is the underlying earnings power of a franchise that combines 2 top 10 regional bank platforms into one, and that power is finally visible in the results. ROTCE at 13.8% climbing is Exhibit A.
And the capital return piece, that's huge here.
$5 billion in share repurchases for 2026 alone. At a market cap of $63 billion, that's roughly 8% of the market cap in a single year of buybacks. Paired with a 4.1% dividend yield, total shareholder return potential is in the 12 to 13% range before any multiple expansion. If you believe the ROTCE story, the multiple expansion on top of that could be substantial.
The fee income diversification is also a real bull case argument.
Investment banking, wealth management, and capital markets hit their best quarter since 2021. These are high-margin businesses that don't require rate tailwinds to grow. In a flat-rate environment where NII expansion is limited, fee income acceleration can bridge the gap and deliver positive operating leverage. Management's confidence in double-digit fee growth for the year is a meaningful statement.
Now the bear case. I'll start. The NII guidance cut is the core issue.
The downward revision from 3 to 4 to 2 to 3% NII growth tells you the rate-sensitive NII engine is under more pressure than management previously anticipated. If rates stay higher for longer and loan growth disappoints, NII could come in at the low end of that revised range, putting the positive operating leverage story at risk and making the ROTCE target harder to hit.
And the commercial real estate credit concern is real.
61 basis points of net charge-offs, with the sequential increase concentrated in commercial construction. With $40+ billion in CRE exposure across office, multifamily, and construction, any deterioration in property values or vacancy rates could trigger elevated provisions for longer and cap the ROTCE recovery. And at 1.54 times tangible book, the valuation has little cushion. Any earnings miss could compress the multiple toward the peer average of 1.2 to 1.4 times, which represents meaningful downside.
Let's put Truist in its peer context, because I think the relative valuation here is actually instructive about how the market is sizing the opportunity.
3 names to compare: U.S. Bancorp, KeyCorp, and Huntington Bank shares, all large regional banks in the same asset size neighborhood as Truist. USB trades at roughly 1.5 times tangible book, very similar to Truist's 1.54, but USB runs a materially higher ROTCE, somewhere in the 16 to 17% range, so you're paying similar multiples for better returns at USB. The bull case for Truist is that its ROTCE catches up to USB's level as the integration tail fully fades and fee income grows, and if it does, the valuation should be at least as high. KeyCorp is at approximately 1.2 times tangible book, a meaningful discount to Truist. Key is also in the middle of a balance sheet restructuring and runs lower ROTCE. Truist's premium to Key reflects the stronger earnings recovery trajectory and the Sunbelt franchise advantage. But Key's discount also shows you what the floor looks like if Truist's ROTCE story disappoints.
And Huntington
is around 1.4 times tangible book, slightly below Truist. Huntington runs a more operationally efficient bank in the Midwest, but its market is slower growing than Truist's Sunbelt footprint. The slight premium Truist commands reflects the demographic tailwind argument, but Huntington's tighter expense management is a valid counter-argument.
The peer picture suggests Truist is fairly priced relative to where its earnings power currently is. But the upside is substantial if management delivers the ROTCE improvement they've outlined.
That's the crux. The stock is not cheap on current metrics. It becomes cheap on 2027 metrics if the ROTCE targets are hit. The investment question is whether you trust the management team to deliver over a 2 to 3 year horizon.
What are options participants saying about Truist here? Because the positioning post-earnings tells a useful story.
The put-call ratio has settled at about 0.95 post-earnings. That's close to neutral but slightly elevated, reflecting some continued hedging demand around the NII guidance reduction and the commercial real estate credit risk narrative. Options participants aren't uniformly bullish after this quarter.
IV percentile at 55, so above the midpoint. The uncertainty hasn't fully resolved despite the EPS beat.
Right. Implied volatility in the 55th percentile suggests more uncertainty than typical, which makes sense given the competing narratives. Strong EPS beat and capital return story on the bull side, NII guidance cut, and elevated NCO on the bear side. The market is genuinely unsure which narrative dominates over the next several months.
Notable positioning.
Call activity at the $55 and $60 strikes in June and September expirations. That's the ROTC recovery camp positioning for a move toward analyst price targets. Put interest at the $46 and $48 strikes represents downside protection for holders managing risk around a potential NII guidance miss scenario. The range of positioning reflects the bull-bear split we see in the analyst community.
As always, options data tells you where participants are positioned, not where the stock is going. Worth noting, not a conviction signal. Let's check insider activity for Q1.
No significant open market purchases from management or the board in Q1 2026. 2 executives sold shares through pre-scheduled 10b5-1 plans. The CFO of a subsidiary and the chief accounting officer each reduced positions in January and February.
10b5-1 plan sales are the standard caveat. These are pre-arranged and not read as directional. The more meaningful signal?
The company itself is the biggest buyer. $1.2 billion in Q1 share repurchases at prices around $50, with a $5 billion full-year target. That's management putting the capital allocation decision where their conviction is. Buying back stock at 1.54 times tangible book implies they believe intrinsic value is substantially higher.
Let's run through the key risks and watch points heading into Q2.
The top risk is the NII trajectory. The downward guidance revision from 3 to 4% to 2-3% means there's less margin for error. If Q2 NII prints below Q1's $3.6 billion level rather than above it, the full-year growth target is in jeopardy, and the positive operating leverage thesis becomes harder to defend.
Commercial real estate credit quality. The commercial construction NCO increase was the headline credit concern this quarter.
With $40+ billion in CRE exposure across office, multifamily, and construction, any deterioration in property valuations or vacancy rates in Truist's markets could trigger elevated provisions that cap earnings recovery. This isn't a crisis-level risk today, but it's the scenario that could extend the ROTC timeline.
The valuation risk at 1.54 times tangible book, any miss gets amplified relative to peers trading at 1.2 to 1.4 times.
The premium multiple means the stock has less cushion than a peer like KeyCorp at 1.2 times. And the key metric to watch heading into Q2, if NII recovers above Q1's $3.599 billion, tracking toward the run rate needed for 2 to 3% annual growth, the concern from this quarter evaporates. Pair that with a flat or declining commercial construction NCO rate, and the bull case narrative gets materially more traction.
Let's bring it all together on Truist.
Truist is a legitimately improved bank at a meaningful inflection point. The merger integration is done. The TIH insurance sale capital has been redeployed. ROTC is climbing, 13.8% in Q1 with visible targets at 4% and 15% over the next 2 years. Fee income is growing. The $5 billion buyback is real capital return, not optionality.
But the complications haven't fully cleared. The NII guidance cut is a real data point. The commercial construction NCO rate is a real risk, and the NEM of 3% is below the peer average. It tells you the funding cost picture hasn't fully resolved.
The investment thesis is a 2 to 3 year hold. You are buying into the delivery of the ROTC improvement from 13.8% to 15% plus, which at a peer average multiple of 1.4 to 1.5 times tangible book would put the stock somewhere in the mid to high 60s. You're getting paid 4% in dividends while you wait. The risk is that macro headwinds or commercial real estate credit deterioration push the timeline out.
The 10.7% consensus upside to $56 is the conservative case. The Morgan Stanley target of 63 and the ROTC to multiple math suggests substantially more upside if the 2027 targets are delivered. This is a stock where the range of outcomes is wider than most in regional banking, and the options positioning reflects exactly that.
A closing thought from Warren Buffett. It takes 20 years to build a reputation and 5 minutes to ruin it.
In a way, that quote perfectly describes what Truist has been dealing with. The BB&T and SunTrust brands had decades of reputation each. The merger created complexity that, for a while, put that reputation at risk. Now the question is whether the new Truist institution is building its own 20-year reputation, or whether this integration story has one more chapter of disappointment left in it. The Q1 results suggest the former is more likely. That's going to do it for this episode of Charged Alpha. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.